You are sitting at your kitchen table. The mail has just arrived. There is an envelope sitting there, and even before you open it, you feel that familiar knot of anxiety tightening in your stomach. It is your property tax assessment. You know the housing market has been crazy. You know values are up, and you are terrified to see what that number is going to be this year. This is the reality for millions of Americans right now. Property taxes are shifting beneath our feet faster than at any time in the last 3 decades. The landscape is chaotic. We are seeing new exemptions appearing out of thin air. We are seeing aggressive freeze programs rolling out to protect seniors. We have states offering to refund your property taxes entirely, sending checks back to homeowners. We have assessment caps being legislated to stop the bleeding. And in some places, there is even serious talk about eliminating property taxes on primary residences altogether. It sounds like a golden age for homeowners, doesn't it? It sounds like relief is finally on the way. But there is a catch, a massive, expensive catch. The government does not speak plain English. They speak in a code designed to confuse you. They throw terms at you like mill levies, ad valorem, assessment ratios, homestead caps, circuit breakers, floating exemptions, and tax deferrals. It is a language of bureaucracy, and if you do not speak it fluently, you are losing the game. If you do not understand how these specific systems work, you cannot take advantage of them. And if you cannot take advantage of them, I can guarantee you one thing: you are overpaying. You are likely handing over hundreds, if not thousands, of your hard-earned dollars to the county treasurer every single year, money that should be in your retirement account, in your savings, or putting food on your table. Welcome to Tax Hack Pro. I am here to stop the bleeding. Today, we are going to strip away the bureaucratic nonsense. We are going to break down these new property tax changes into language that actually makes sense. I'm not just going to tell you what is changing. I am going to show you the mechanics of the machine. We are going to define the terms, reveal the loopholes, and give you the exact roadmap you need to benefit. By the time this video ends, you will understand the property tax game better than your neighbors, better than your real estate agent, and maybe even better than the person working at the assessor's office. Let's start at the very bedrock of the system. We need to understand how your property tax bill is actually calculated, because once you see the formula, the matrix reveals itself, and everything else falls into place. Here is the basic equation. It looks simple, but looks can be deceiving. The formula is assessed value multiplied by the tax rate equals your property tax bill. On the surface, that is third-grade math. But in the real world, both parts of that equation are complex, moving targets. And understanding that complexity is the secret key to unlocking your savings. Let's tackle the first variable, assessed value. This is where the vast majority of homeowners get lost. You have to understand that assessed value is not the same thing as market value. Market value is the exciting number. It is what Zillow says your house is worth. It is what your neighbor sold their house for last week. Let's say, for this example, the market value of your home is $400,000, but assessed value, the number the government uses to decide how much you owe, can be a completely different animal. This depends entirely on the state you live in. Many states do not tax you on the full value of your home. They tax a percentage. This is called an assessment ratio. Let's look at Texas. In the Lone Star State, they play hardball. They assess it 100%. So if the market says your home is worth $400,000, the tax man agrees. Your assessed value is $400,000. Now, let's travel to Georgia. In Georgia, the assessment ratio is 40%. That is a huge difference. So that same house, with the same $400,000 price tag on the open market, is only assessed at $160,000 for tax purposes. Now let's go even deeper into the South, to South Carolina. For owner-occupied homes, meaning you actually live there, the assessment ratio is just 4%. 4%, so your $400,000 home. The tax assessor writes it down as $16,000. Same house, same market value. Vastly different taxable numbers depending on the invisible lines of state borders. If understanding these hidden mechanics could save you money, do yourself a favor and subscribe to Tax Hack Pro right now. We are dedicated to breaking down these complex financial topics so you can actually use the information to protect your wealth. So why does this ratio matter? Why am I spending time on this? Because when politicians or news anchors talk about a $50,000 exemption, that exemption means completely different things depending on where you stand. In Texas, a $50,000 exemption comes off the full value. It helps, sure. But in a state like South Carolina, a $50,000 exemption against a $16,000 assessment would wipe out your tax bill 3 times over. The same number has a drastically different impact on your wallet. You have to understand your specific state's math to know if a tax cut is actually a big deal or just a rounding error. Now, let's look at the other side of the equation. The tax rate, you will often hear this referred to as the mill levy or millage rate. What is a mill? It sounds medieval. A mill is simply $1 of tax for every $1,000 of assessed value. Or in simpler terms, 1/10 of 1%. So if your tax rate is 100 mills, that means you are paying 10% of your assessed value in taxes. But here is the secret that most people do not realize. Your tax rate isn't one single number decided by one person. It is a layer cake. It is multiple rates from different government entities stacked on top of each other. You have the school district tax. This is usually the biggest slice of the pie. Then you have the county tax, then the city or municipal tax. Then you have the special district taxes. These are the ones that sneak up on you. The fire protection district, the library district, the mosquito control district, the community college bond. All of these entities take their little slice, and they combine to form your total mill levy. Why does this matter? Because when you hear about new relief programs, they are often targeted. You might hear about a new exemption for school taxes. That means it only lowers that one layer of the cake. It doesn't touch the county tax or the city tax. Understanding the layers helps you see exactly where your savings are coming from and where they aren't. Let's put it all together with a real-world example so you can see the math in action. Let's take that $400,000 home. Let's say you live in a state with a 10% assessment ratio. That gives you an assessed value of $40,000. Now, let's say your combined mill rate is 100 mills, or 10%. You multiply 40,000 by 10%. That equals a $4,000 tax bill. Now, here is the insight that changes everything. Relief programs, the hacks we talk about, target specific parts of this formula to lower that final number. Exemptions attack the assessed value. They chop it down. Freezes put a force field around the assessed value so it cannot rise. Caps put a speed limit on how fast that value can grow. Rate limits try to control the mill levy side of the equation. Once you understand the formula, you are no longer looking at a confusing bill. You are looking at a math problem that can be solved. Assessed value times tax rate equals your bill. Now that you understand the game board, let's look at the pieces. There are 5 main types of property tax relief, and right now, states are rapidly expanding all of them. This is the new frontier of tax policy. The 5 types are exemptions, freezes, caps, deferrals, and refunds. Each one works differently. Each one has different rules. Each one requires a different strategy. And knowing which ones your state offers, and more importantly, which ones they just expanded, could be the difference between a comfortable retirement and being forced to sell your home. Let's break them down one by one. Type 1. Exemptions. This is the most common form of relief. An exemption reduces your assessed value by a fixed dollar amount. It basically makes a portion of your home invisible to the tax collector. If you have a $100,000 homestead exemption, the first $100,000 of your value simply does not exist for tax purposes. But it gets better. Senior exemptions often stack on top of that. In Texas, for example, seniors get an additional $10,000 exemption on top of the massive $100,000 exemption everyone else gets. Veterans with disabilities often get even larger exemptions, sometimes up to 100% of the value. The big trend right now is that states are realizing their old exemption numbers are peanuts compared to modern home prices, so they are drastically increasing these amounts. Texas jumped from $40,000 to $100,000. That is huge money back in your pocket. Type 2. Assessment freezes. This is the golden ticket for retirees. A freeze locks your assessed value at a specific point in time. The most common version is the senior freeze. The year you turn 65, you apply for the freeze. Whatever your assessed value is on that day, that is where it stays. Forever. Your neighborhood could become the hottest market in the country. Values could double, triple, quadruple. Your neighbor's taxes could skyrocket, but yours stay frozen in time. This is the ultimate protection against gentrification and inflation. It ensures that you are never taxed out of the home you spent your life paying for. More and more states are rolling out these freeze programs because the political pressure to protect seniors is immense. Type 3. Assessment caps. A cap is like a governor on an engine. It limits how fast your assessed value can increase in any single year. Think of California's famous Proposition 13. It caps increases at 2% annually. Florida has the Save Our Homes cap, which limits increases to 3%. Why is this vital? Because markets are volatile. We just saw home values jump 20, 30, even 40% in some areas post-pandemic. Without a cap, your tax bill would have jumped 40% in 1 year. That is a budget-destroying spike. A cap smooths that out. Even if the market goes crazy, your bill can only creep up slowly. More states are implementing these caps to protect homeowners from the whipsaw effect of the housing market. Those first three, exemptions, freezes, and caps, all work by reducing the assessed value part of the formula. But the next two types are different. They are changing the game entirely. Type 4, deferrals. A deferral program does not reduce what you owe. It changes when you pay it. Think of it as a pause button. Under a deferral program, the state or county pays your property taxes for you right now. You do not write a check. You keep that money in your bank account. Then when you eventually sell the home, or when you pass away and the estate is settled, the taxes are paid back from the proceeds of the sale, usually with a small amount of interest. The interest rate on these programs is usually way below market rates, significantly cheaper than a home equity loan or a reverse mortgage. Think of it as the government giving you a low-interest loan against your equity so you can stay in your home. These programs used to be rare and hard to qualify for, but states are making them accessible because they solve a liquidity problem. Seniors are often house-rich but cash-poor. Deferral fixes that. Type 5, refunds. Sometimes called circuit breakers, this is the most direct approach. You pay your property taxes like normal. Then you file a form with the state, proving your income and your tax burden. If the taxes are too high relative to your income, the state cuts you a check. They refund you. Nebraska has pioneered an incredibly aggressive version of this. Their program can refund up to 100% of the property taxes you paid. It is called a circuit breaker because it breaks the electrical circuit before the system overloads. It stops the tax burden from crushing your finances. This model is spreading like wildfire because it is simple, and voters love getting a check in the mail. So we have 5 pillars of relief: exemptions, freezes, caps, deferrals, and refunds. Now let's talk about the landscape. What is happening nationally? Why is this happening now? It isn't random. There is a war going on between the states. They are competing. They are competing for you. They are competing for retirees. They know that retirees bring stable income, they don't burden the school systems, and they spend money in the local economy. States are using property tax relief as a weapon to steal residents from other states. When Texas raised its exemption, other states panicked. When Nebraska started sending refund checks, legislators across the Midwest took notice. We are seeing a race to the bottom, in the best possible way, states trying to outdo each other on tax relief to keep you happy. Let me outline the 5 specific trends driving this revolution. Trend 1. Record-breaking exemptions. We already mentioned Texas. Their jump to a $100,000 exemption is historic, but it signals a realization across the board. Exemptions set in 1990 don't help anyone in 2026. Inflation has eroded the value of those old exemptions. States are finally updating their math to reflect reality. If your state hasn't raised its exemption recently, keep your ear to the ground. The pressure is building. Trend 2, the expansion of the freeze. Being taxed out of a paid-off home is a political nightmare for any governor. It looks terrible. Stories of grandmothers losing their family homes because of taxes resonate deeply with voters. The freeze is the direct response to that. It is becoming the standard for senior protection. If your state doesn't have a freeze yet, lobby for it. It is coming. Trend 3, the refund model is going viral. Nebraska proved it works. It is politically popular. It feels like a bonus, even though it is just your own money coming back. Legislators love programs that involve sending checks to voters with their names on them. Expect to see more circuit breaker, refund programs popping up in purple and red states. Trend 4, accessible deferrals. Historically, deferral programs were looked down upon. They were hard to get into, with strict income limits and confusing paperwork. That is changing. States are loosening the income limits. They are simplifying the applications. They are realizing that allowing a senior to defer taxes is cheaper for the state than dealing with the social fallout of homelessness or displacement. Trend 5, the elimination movement. This is the big one. The nuclear option. North Dakota is attempting something radical. They are pushing to eliminate property taxes on primary residences entirely, not reduce, eliminate, zero. They plan to use oil and gas revenue to fund the local governments instead. If this passes and succeeds, it will send shockwaves through the country. Other resource-rich states will be forced to consider it. It is the most aggressive move we have ever seen, so the table is set. The programs are there. The trends are in your favor, but now we have to talk about the dark side. We have to talk about the reason most people never see a dime of this money. Here is the frustrating, painful reality that separates the people who save thousands from the people who pay full retail price for their government. Almost nothing in this system is automatic. You must apply for the exemptions. You must file the paperwork for the refunds. You must actively enroll in the deferral programs. And in many cases, you must renew these applications every single year. And here is the kicker. Nobody is coming to save you. The government is not going to knock on your door, smile, and hand you a bag of cash you forgot to claim. Your county assessor is not going to call you and say, "Hey, I noticed you turned 65, let me lower your bill." If you do not take action, you do not get the savings. It is that simple, and frankly, it is that cruel. Why isn't it automatic? Think about it from their perspective. The county doesn't know your age unless you prove it to them. They don't know your income unless you report it. They can't verify that a property is your primary residence and not a rental or a vacation home without you signing an affidavit. But there is a cynical side to this too. Government budgets are often built on the assumption of breakage. They assume that a certain percentage of eligible people simply won't apply. They count on your laziness. They count on your ignorance. The friction is part of the design. It keeps the costs down. And then there is the deadline trap. This is where they catch the most people. Most property tax relief deadlines fall in that window between January and April. If the deadline is April 15th and you realize on April 16th that you missed it, guess what? You are out of luck. There are no extensions. There is no grace period. There is no sympathy. You have to wait 12 full months for another chance. That is 1 year of savings flushed down the toilet because you were 24 hours late. The result of this bureaucracy is tragic. Millions, literally millions, of dollars in exemptions go unclaimed every single year. We are talking about seniors who are eating cat food to save money, who are eligible for thousands in tax relief, but simply don't know the forms exist. We are talking about people who thought they were enrolled, but the county purged the rolls, and they didn't see the renewal notice. You cannot assume anything. You cannot assume you are enrolled just because you were enrolled last year. You must verify, but there is a glimmer of hope. Some states, like Texas, are generous with retroactive applications. In some cases, you can apply retroactively for up to 2 years. If you find out today that you were eligible 2 years ago, you might be able to file paperwork and get a refund check for those past years. But you have to check your specific state's rules. So, we have established the problem. We have established the opportunity. Now, here at Tax Hack Pro, we deal in solutions. I am going to give you a framework. This is a battle plan. It doesn't matter if you live in Maine, Florida, Idaho, or California. This 7-step system works everywhere. This is your action framework. Step 1, know your current status. Stop guessing. Go find your most recent property tax bill. Dig it out of the filing cabinet or log in online. Look at it. What is your assessed value? Not what you think it is. What does the paper say? Look for a section called exemptions. Is there anything listed there? Does it say homestead? Does it say senior? If that section is blank, you have a problem. You need to know your baseline before you can improve it. Step 2, research your state's menu. You need to know what is on the menu. Go to your county assessor's website, or if you hate computers, pick up the phone and call them. But don't just ask, "How do I lower my taxes?" That is too vague. Ask specific questions. Do you have a senior freeze program? What is the homestead exemption amount? Are there deferral options for retirees? Is there a circuit breaker refund? Force them to give you the full list. Step 3, check your eligibility. Now you have the list. Go through it line by line. Look at the age requirements. Is it 62, 65, 70? Look at the residency requirements. Do you have to live there 6 months a year, all year? Look at income limits. Some programs are for everyone, some are means tested. Don't disqualify yourself. Let them tell you no. You might qualify for 3 different programs that stack on top of each other. Step 4. Get deadlines in writing. This is life or death for your savings. Find out the exact date the application is due. Write it down. Put it in your phone. Put it on the fridge. Tattoo it on your arm if you have to. And ask the second question. Is this a one-time application, or do I have to do this every year? You need to know if you're signing up for a subscription or a one-time purchase. Step 5. Apply early. Do not be the person running to the post office at 4:55 p.m. on the day of the deadline. Apply at least 2 weeks early. Government systems crash. Mail gets lost. Clerks make mistakes. Give yourself a buffer. Keep copies of every single piece of paper you submit and follow up. Call them a week later and say, "Did you receive my application? Is it complete?" Make them confirm it. Step 6. Verify the result. You applied. Great. Do not celebrate yet. When your next tax bill arrives, scrutinize it. Check that exemption box again. Did the number change? Did the freeze take effect? Errors happen all the time in county government. It is your job to audit them. If it isn't there, fight it immediately. Step 7. Set the annual trap. If you found a program that requires annual renewal, set a recurring reminder in your calendar right now for next year. And even if you don't need to renew, set a reminder to check for new programs once a year. As I told you, laws are changing fast. A program that didn't exist in 2025 might save your life in 2026. Stay vigilant. This is the Tax Hack Pro method. The system is designed to be confusing. It is designed to be opaque. It is designed to maximize revenue for the state, not savings for you. But now you have the decoder ring. You understand the formula. You know the 5 types of relief. You see the trends, and you have the 7-step battle plan. Do not let them keep your money. Go get what is yours. If this breakdown helped you see through the fog, hit that like button. Subscribe to the channel. We are building a community of people who refuse to be victims of the tax code. Share this video with your parents, your neighbors, anyone who owns a home. Knowledge is power, but only if you use it. I'm Tax Hack Pro. Stay sharp, and I'll see you in the next video.